Okay, dear student, let's just start our really grand live revision class of SBR. In today's class, inshallah, we'll be discussing the entire consolidation and the past paper questions as well, which we have already shared in the WhatsApp group. And if you recall the previous week, which we in the previous week we were supposed to revise 5 questions, if I'm not wrong. So out of 5, we have so far done 4. So one question is still left from the last week. So I'll cover that as well. If that question is not going to be covered today, then I'll cover tomorrow. But don't worry at all. We will cover that as well. Now let's just start consolidation. Basically, when we say group accounting, I hope these handouts are with everyone. Okay. We have shared this I would say a very short notes of SBR. I think within 84 pages, you will see each and everything. So number 1, IFRS 10 consolidated financial statements. The definition of parent is an entity that controls another entity. Parent is an entity that controls another entity. Normally, parent is an organization which gets more than 50% plus ordinary shareholding in the subsidiary. Then normally, we say parent is having a control. For example, if parent is having 70% holding, then NCI will have 30% holding. Non-controlling interest will be 30%. But everybody knows that normally what happens when parent is having more than 50% holding in the subsidiary, parent gets the control. But it is not necessary. It is not necessary to become a parent. You will always have to have more than 50% holding. There's a possibility that parent is having even less than 50% holding, still parent is having a control. Because according to IFRS 10, voting right is not the only criterion. There are other factors also which you have to consider. But if, again, let me repeat, normally what happens when one company gets more than 50% holding in another company, then the acquirer is having the control. A subsidiary is an entity that is controlled by a parent. This is important. Now, IFRS 10 says that investor has control when it has. Students, I have discussed in the previous class in the WhatsApp group as well. See, within 84 pages, we have covered the entire SBR, the main area of SBR. At least I would request, at least I would say whatever is available in these 84 pages, obviously after understanding, you should memorize them as well. That will really help you when you will be answering the question in exam. Obviously, these 84 pages are not the replacement of our regular notes, which are very comprehensive. You people, I think, should have noticed that. But right now, of course, near to the exam and plus these 84 pages, they will extraordinarily help you. Like in IFRS 10. IFRS 10 says that investor has a control when it has 3 points. Number 1 is the power over the investee. Now, power over the investee can be seen through voting rights, through holding. Power over the investee. This is number 1. Number 2, exposure or rights to variable return from the involvement in the investee. Can I say if you are having, let's say, 45% holding in XYZ company. So, and let's say you are also involved in the relevant direct activities of that company. For example, your company is involved in the operating activities of that company, investing activities, financing activities. So definitely, due to your involvement, investees' return will be affected. And plus, you are also exposed to that variability in the return. Why? Because you are having around, let's say, 45% holding, 50% holding. So if something goes wrong, So you will have to face that as well. If something goes good, so you will get the benefit as well. The ability to use the power over the investee affects the investor's return. So your ability to use the power, voting right. Let's say we want to make a decision in that company, and assuming you are having a 55% voting rights, so whatever you are going to say, that will happen. So the ability to use power over the investee to affect what? Investors' return. It will just not impact your return, it will impact the other investors' return as well. So according to IFRS 10, which company is having a control and who is the investor has a control when? Number one, I'll see the holding. Number two, I'll see when investees returns, there's a fluctuations in the investees return. Are you exposed to that or not? For just an example, okay, if you're working somewhere as an employee, can I say either that company is making a good profit or bad profit? It is not impacting you. You're getting a fixed salary. But here, I'm not an employee, I'm the investor. I'm having, let's say, more than 50% holding. So if that company makes a really good return, I'll get the benefit. If that company performs poorly, I'll face it. And the ability to use power over the investee, definitely that affects investor returns. My voting power affects the investor's return. An entity that is a parent is required to produce consolidated financial statements. It is the responsibility of the parent. It is the responsibility of the parent to produce consolidated financial statements. Now, student business combination, extremely important. Most of the time, student, they just overlook the concept of business combination, and when it comes in exam, they end up by making, I would say, silly errors. See, you should have a really good concept that either your company has acquired a company, either your company has acquired a business, or your company has acquired just the assets. For example, if A PLC says, I have acquired the B PLC. If this B PLC is a proper business, then there is going to be a consolidation. I'll prepare the group accounts. What if, after looking each and everything, if I come to know, no, sir, you did not acquire a B PLC, you have acquired just the assets, there will be no more consolidation. For example, if I say the entire B PLC is having only two assets, that's it. And there's no operating activities, there's no employees, nothing at all. Let's say the name of the company is BPLC, but they have just got two shops. That's it. No operating activities, no employees, nothing. So logically, I'll say APLC, you did not acquire the business. You just acquired the assets. Go for IAS 16 rather than thinking for the consolidation. So there has to be business combination. You acquire a business. After that, think for a consolidation. IFRS 3 business combination states that acquisition method is used to account for a business combination. Now, this is important. Business combination is where an acquirer obtains control of a business. If you're just getting assets and it is not a business, no more consolidation. Concentration test, very important. An optional concentration test can be used to assess whether an acquired set of assets is not a business. As I'm just giving you in the example, the entire BPLC is having just two shops, no operating activities, nothing, no employees, nothing at all. So we'll end up by saying it is not a business. You have just acquired the assets. The acquired assets are not a business if substantially all of the fair value of total assets acquired is concentrated in a single identifiable asset or a group of similar assets. I've just given you the example. The acquired assets are not a business If substantially all of the fair value of total assets acquired is concentrated in a single identifiable asset or group of similar identifiable assets. If this is the case, we'll say it's not a you have not acquired a business. Like, I'm just repeating the example again, that APLC says we have acquired a BPLC, but BPLC is having just 2 shops, no employees, no operating activities, nothing. So you go for IAS 16 rather than anything else. So we have to apply. So you have to see the scenario. Sometimes it comes in a normal theoretical question where examiner has asked, even in the past paper as well, that let's say parent has acquired the business. Is it a business or it's not a business? So you have to have a really good idea about the concentration test. What it says, the acquired assets are not a business if substantially all of the fair value of total asset acquired is concentrated in a single identifiable asset or similar identifiable assets, group of similar identifiable assets. Now come here. Elements of a business. Let's talk about elements of a business. If the concentration test is not met, let's say this is not the case that everything is in one asset or 2 assets. This is not the case. It means concentration test is not met. Or if test is not applied. 2 things. Because a concentration test is an optional concentration test. So 2 points, students. If the concentration test is not met, one possibility, or if the concentration test is not applied, a detailed assessment is required to assess if a business has been acquired. So a very important concept is concentration test is an optional test. Obviously, if concentration test is met, then definitely no need to do anything else. It is not a business combination. But if concentration test is not met or it is not applied, then I'll go for a detailed assessment is required to assess if a business has been acquired. To meet the definition of a business, look at this. Inputs and substantive processes must have been acquired that can be contribute to creation of output. It's very important. When we say business, you will see inputs. We'll be using them to get outputs. Definition. Inputs are economic resources that can create outputs once processes are applied. Let's say we are a car manufacturer. We get the raw material, that is our input. We convert that input into a car, and the car is the output. So inputs are economic resources that can create output once processes are applied. So are you getting this point? Inputs are the economic resources, but just input will not result in output. Okay, that is also very important. Can I say if a car manufacturers, they just buy the raw material? Raw material automatically will not become the car. Raw material will not automatically become the output. So inputs are the economic resources that can create output once processes are applied. When we say processes are systems, standards or rules that can create output when applied to inputs. Output is your goods, it could be services and income. Like for example, if I talk about my college, if I talk about my college, ASA, so right now, the new Finance Act 2024 just they have launched. So we have to prepare all the lectures. I'm going to prepare all the lectures of Finance Act 2024, and obviously after that we are going to sell it. Right now, I have bought all the material of Finance Act 2024. Can I say just buying all of the material of Finance Act 2024, that will not make my lectures ready. After buying all the material of Finance Act 2024, I have to convert that into notes. I have to properly record the lectures, and then those lectures will be sold. So it means just getting the material of Finance Act 2024 is not enough. That input will have to go to through certain processes to become output. Now let's talk about acquisition method. So please, one thing, if examiner is asking you, is it a business, either APLC is acquired a business or not, first try to see the concentration test. If concentration test is met, if you can identify that entire value is in one asset, or just in substantially the entire value is in one asset, or in a group of identifiable similar assets, no need to go for the detailed assessment then. But if concentration test is not met, or you have not applied, or you don't want to use it, then go for this inputs, processes, and output. Don't forget, inputs are the economic resources that can create output once processes are applied. Processes are systems, standards, or rules that can create outputs when applied to inputs. And then we have got output. Now, acquisition method. The acquisition method has 4 requirements. The acquisition method has how many requirements? 4. Identify the acquirer. It looks very easy, okay? Sir, what is the difficulty in identifying the acquirer? Come on, guys. There are questions in the past paper where examiner has given you around 10 marks to just identify which company is the parent. So it means it is not always so easy to identify the acquirer. So the acquisition method has 4 requirements. Identify the acquirer. Identify the acquisition date. Again, you might be thinking, so what is so important and why it is so difficult to find out? It is. Identify the acquisition date. Just if you recall, we are going to discuss as well, the concept of step acquisition. Step acquisition means acquisition of a subsidiary in stages. So logically, the acquisition date will be the date when parent has got the control. So that is the acquisition date. So it means identifying the acquisition date, again, it will not be always so straightforward. Then we say acquisition method. Recognize subsidiaries net asset at fair value. Recognize goodwill and obviously NCI. I know we'll see that either it is a full goodwill method, partial goodwill, don't worry at all. Identify the acquirer. Students, to be very honest, if you have a really good grip on just these 84 pages, I can just assure you that theoretical part of SBR will never disturb you, seriously. But you have to have a really good grip. Why? See, I've told this many times in my other live revision classes as well. Nobody is expecting the same volume which examiner produces. Obviously, within an examination environment, nobody can produce that volume which examiner produces. There's no issue you are writing less, but the point is you write correct. You will get marks. Quality of the answer will give you marks, not the quantity. The acquirer is an entity that has assumed control over another entity. The acquirer is now very important concepts are coming right now. The acquirer is normally the company that has transferred cash, other assets. There's a possibility that parent has given a land to the subsidiary, or there's a possibility parent has issued the shares in the business combination. The acquirer is normally the company that has transferred cash, other assets, or other asset, for example, okay, land, shares in the business combination. Now, shares. a very simple concept. Come here. Assuming A PLC has acquired BLC. Assuming A PLC got 70% holding in B PLC. Okay. And let's say acquisition date is 1/1/25. Okay. Consideration. Assuming parent has paid, cash paid is 40 million. In addition to the cash, please keep listening, then I'll be asking a question and I need answer from you, okay? In addition to that, APLC has issued 30 million shares to BPLC. Repeat. A has acquired 70% shareholding in BPLC. The consideration, the cost of investment. Parent has paid cash 40 million, okay? In addition to that, parent has issued 30 million shares to BPLC. Okay. This 30 million is also a part of cost of investment. Parent has issued 30 million shares also to acquire BPLC. Fine. Now, what is the question? The question is, the acquisition date is 1/1/25. Okay. 1/1/25. APLC share price. Student, APLC share price is 2 per share. Repeat. 1/1/25. APLC market value is 2 per share. And let's say, I'm just assuming, make it 25th January 25. Share price is 3. Great. Please. APLC has issued 30 million shares to acquire BPLC. At acquisition, the share price is 2. Then examiner has given us the information after 25 days. The share price was 3. And now look at this. APLC issued 30 million shares to BPLC on 25 January 25. Student, I have a question. Can you quickly tell me what is the cost of investment, total cost of investment of parent? The acquisition date is 1st January, when the share price of the parent was 2. But after 25 days or 24 days, whatever you say, the share price of the parent becomes 3, and actually parent has issued the shares on 25th January 25th. My question is, what is the cost of investment? There are 2 options. I want which one is the right answer. Cost of investment. Okay, let's see what the students are saying. Okay, let's see. Cash, 40 million. Obviously, we have to take the market value of shares as well. Students, 30 million. You will 30 million multiply by 2 or 30 million multiply by 3. Answer, please. Look at this. 30 million multiply by 2. So the cost of investment of parent is 100 million. Now listen, it is always the share price at acquisition date. It is not the share price when actually parent has issued the shares. Repeat, please listen to this carefully. Examiner has categorically mentioned that parent has actually issued 30 million shares to the subsidiary on 25th of January. On that day, the share price was 3. But on acquisition date, the market value of the parent is 2. So it is always the current share price on acquisition date rather than when actually parent is issuing the shares. Is this clear to everyone, students? I hope it is clear. Great. Come back. The acquirer is normally the company that has transferred cash, other assets, or shares in the business combination. Other factors to consider include other factors. Which entity former management dominates the combined entity? Let's say in combined entity, there are 6 directors. Out of 6, 4 belongs to APLC. That is another indicator of being a parent. You have to see this as well. Which entity's former owners have the greatest number of votes in the combined entity? We have to see this as well. Who has the, let's say in a combined entity, 51% holding belongs to APLC and 49% belongs to BPLC. So then it means 51% is another indicator of checking which company is the parent. Which entity was bigger? This is also very important. Normally, I'm not saying exceptionally it's a world anything can happen, but normally what happens, you will see a bigger company acquiring a small company. A bigger company acquiring a small company. Student, just these few lines can give you 10 marks. Because if a question comes for 10 marks, let's say, and you just need to identify that which company is the parent, you're not going to write all these 5 lines without reading the scenario. You have to read the scenario, and from the scenario, I'll take some of the data. For example, from the scenario, I've seen that APLC is given cash. I'll take out that point. From the scenario, let's say I've seen that APLC is issued the shares. I'll take that point as well. Now, I've read the question, and the question says that in a combined entity, let's say, after getting a control, assuming there are 6 directors, 4 belongs to, assuming APLC. So I'll take these points. So I would say you will take around 40 to 50% of the material from the scenario, and you will be just applying these few concepts which we have just discussed. And automatically you will reach on a conclusion that which company is parent. So I hope this is very clear to everyone. When you just need to obviously, if you are just giving a single line answer for a 10 marks, you will be getting 0 marks. For example, you have read everything and you just written a single line that APLC is the parent. Where is the justification? If you're not providing the justification, sorry, no marks at all. If you're not linking your answer with the scenario, no marks at all. Student, what to see in the scenario? Just these few concepts, they have given you a clear idea. Yes or no, please reply. I'm not saying to carry such a big amount of knowledge. Just these few concepts, if they are in your mind, look at the scenario, read the scenario by keeping these things in your mind. That which company has given the consideration. After the combined company, check who is dominating in the management. Check which company was a bigger company. Check who has the highest voting rights. I hope this is clear to everyone, student. Yes or no? I strongly believe just these lines, students, I'm not putting my students to go in a really big amount of detail and just keep reading and reading. There's no benefit at all. If this much knowledge can serve my purpose of identifying the acquirer, so why would I be wasting my time? Just this much is more than enough. I hope I've just given you my entire message. Now come here. Identify the acquisition date. This is the date on which the parent obtained control over the subsidiary. Very important concept of acquisition date comes when we are dealing with a step acquisition. Because in a step acquisition, consolidation will only start when parent has got the control. Not before that. Only consolidation will start when parent has got the control. Recognize the net asset. The acquirer must measure identifiable assets acquired and liabilities assumed at their fair value at the acquisition date. Very important, students. It is the responsibility of a parent when you have got the control. Then at acquisition, you have to bring all the net assets of your subsidiary at fair value. And here, the concept of the fair value adjustment also comes. Fair value adjustment is just the difference. At acquisition, for example, the carrying amount of property, plant, and equipment in individual books of subsidiary is different, and the fair value at acquisition is different. So the difference is fair value adjustment. We'll be discussing this later on in a really good detail. Don't worry at all. But you need to know one thing. At acquisition, you have to bring all the net asset of your subsidiary at fair value. Recognize goodwill and NCI. When calculating goodwill, purchase consideration is measured at fair value. Purchase consideration is measured at fair value means what? If parent has issued the shares, so can I say issued shares multiplied by the share price at acquisition? Fair value. Got it? Another concept of fair value. Listen, whatever cash you have paid, I'll take that value as it is. Third, listen this. Third, students, listen and give me the answer. Let's say there is a deferred consideration that parent will make the 100 million payment to the subsidiary after 2 years. So student, tell me, what amount of deferred consideration you will take into the cost of investment? Let me repeat my question. There's a deferred consideration of 100 million and parent will pay that 100 million after 2 years. So what amount of deferred consideration? Just give me the concept. Will you take 100 million as it is, or what will you do? I'm waiting, students. Okay, let's see. Perfect. We'll take the present value of deferred consideration. Excellent, everyone. Excellent. I'm really happy for everyone. Great. We'll take present value of deferred consideration. Okay. And if there is any contingent consideration, then examiner will give you the fair value at acquisition. I'll take the fair value of that contingent consideration. Professional fees are expense to the P&L. They will never be a part of your cost of investment. The non-controlling interest at acquisition can either be at fair value. If examiner says it is the group policy to keep the NCI at fair value, it means full goodwill. We'll be actually going for the full goodwill. But if examiner says it is a group policy to keep the fair NCI at proportionate of the fair value of net asset, then it is a partial goodwill. Proportionate share of the fair value of subsidiaries identifiable net asset, it means partial goodwill. And logically, in case of partial goodwill, listen carefully. In case of partial goodwill, whatever the impairment loss comes, logically, entire impairment loss belongs to parent. But if it is a full goodwill method and the impairment loss comes, then that impairment loss will be shared between parent and NCI according to their holding. Repeat, full goodwill, there's an impairment loss. That impairment loss will be shared between parent and NCI according to their holding. If it is partial goodwill, whatever the impairment loss comes, it only goes to parent. It will only be charged to parent. Goodwill impairment is tested annually for impairment. Annually, student, again, very important point. If a group says we do not want to test the goodwill annually, that's incorrect. You have to do that. So according to IAS 36, in case of goodwill, purchase goodwill, you have to perform the test annually. Either there is indicator of impairment loss or not. Goodwill does not generate independent cash flows, so it is tested for impairment as a part of cash generating unit. For example, for exam purposes, this is normally a subsidiary. Yes. So now come here. Definition. A cash generating unit is the smallest group of assets that generate cash inflows that are independent from other cash inflows in this business. Goodwill obviously is not generating any cash flows independently. So test for impairment as a part of cash generating unit. For exam purposes, this will be the entire subsidiary. Now come in. Key point. Whether NCI acquisition was measured at fair value or proportionate has a significant impact on impairment review, as I mentioned. Fair value method, full goodwill, whatever impairment loss comes, it will be shared between parent and NCI. If it is a partial goodwill, entire impairment loss is given to the parent. Fair value method, the group has recognized full goodwill. So this can be added together with the other net assets of the subsidiary and compared with the recoverable amount. I'm performing the impairment test. Let's say examiner has given me the recoverable amount of subsidiary's net assets. So it's okay. I'll take all the assets of the subsidiary, including the full goodwill, minus the liabilities. I'll have the carrying amount of net asset. If the carrying amount of net asset is more than the recoverable amount, difference is the impairment loss, and that will be shared between parent and NCI. Proportionate method, only group's share of goodwill has been recognized. So goodwill must be grossed up to include the NCI share prior to performing the impairment review. Now, this is something very important. Fair value method, the group has recognized full goodwill, so this can add it together with the other net assets. Now, let me just give you an idea. Let's say we need to perform impairment test. Impairment review. Let's say examiner has given us the recoverable amount of net assets of subsidiary. The first thing you need to know is, if the carrying amount is more than the recoverable amount, then difference is the impairment loss. The first concept. If carrying amount here we are talking about net assets, so I'll take net asset. If carrying amount of net assets of subsidiary is more than the recoverable amount, difference will be impairment loss. Obviously, if carrying amount is lower than the recoverable amount, there's no impairment loss. And one more thing, please. Once we have charged the impairment, obviously, first, whatever the impairment loss comes, that will be allocated to the goodwill. Now try to understand. Impairment loss of goodwill can never be reversed. Impairment loss of goodwill can never be reversed. In the past paper, once what happened? In year one, there was an impairment loss in the goodwill. In the second year, what examiners did, he just reversed that impairment loss. So it is categorically mentioned in IAS 36 that impairment loss of goodwill can never be reversed. Okay, now If carrying amount of net asset of subsidiary is more than the recoverable amount, difference is the impairment loss. Now, just I want to mention one thing. Assuming that net assets of subsidiary which are equal to equity. Net assets, I'm just performing impairment test. When you first of all, you need to know one thing. Net assets, they are equal to equity. Let's say we need to perform impairment test. So first of all, we need to calculate carrying amount of net assets. Assuming examiner has given us the equity of subsidiary. I'll take the equity of subsidiary at the date when I'm performing impairment test. Equity means total equity of the subsidiary. We know equity means total asset minus total liabilities. Okay, please listen to me carefully. I'll take this equity which examiner has given me on the date when I'm performing impairment test. Let's say examiner has given me the equity. Otherwise, I'll take total asset minus total liabilities, that is equal to equity. Now listen, this equity value I've taken from the individual books of the subsidiary. Now for calculating the carrying amount of subsidiary for a group accounts, I have to adjust this. There's a possibility that in the question there was a fair value adjustment. Assuming there was a fair value adjustment of property, plant, and equipment, I'm assuming I'll take that. If there was any additional depreciation on that fair value adjustment, there's a possibility there was 100 million fair value adjustment in property, plant, and equipment and 10 million additional depreciation. So I will deduct that additional depreciation. So what I want you to say, you have taken equity value from the individual books of the subsidiary. Now that individual value will be adjusted for the group accounts. If there's any fair value adjustment, you have to add that fair value adjustment. If it is a positive fair value adjustment, if it is a negative fair value adjustment, I will deduct. Let's say if it is a depreciable asset fair value adjustment, so I'll deduct the additional depreciation as well. If it is a non-depreciable fair value adjustment, so I'll incorporate that as well. What I want to say, normally from the individual books of subsidiary, I'll take the value of equity on the day when I'm performing impairment test. That equity will be adjusted with the fair value adjustments. Okay, now just keep watching. I will also take the goodwill. I'm just assuming the goodwill is 80 million. And this is a full goodwill method, okay? I'm just assuming the carrying amount of net asset is coming, let's say 250. Let's say the recoverable amount is 200. So there's an impairment loss of 50. I'm assuming parent is having 80% holding and NCI holding is 20. Double entry. 80% of 50 is 40. That is retained earning P&L will be debited by 40. 20% of 50 is 10. NCI will be debited by 10. And obviously goodwill will be credited. Now try to understand. This is when we are having a full goodwill. Assuming it's a partial goodwill question and we need to perform impairment test. Now things are getting a little bit interesting. How will you perform impairment test? Let's say we have taken the equity of the subsidiary on the day we are performing impairment test, adjusted by the fair value adjustments, assuming it is property, plant, and equipment, land, whatever it is. If there is any additional depreciation, I'll take that also. Now listen. Assuming parents holding is 80%, so obviously NCI holding is 20. Now gross up goodwill means what? Try to understand. Initially, if it is a partial goodwill method, so whatever goodwill you have calculated, that is a partial goodwill. It only represents the goodwill portion which belongs to parent. So goodwill, I'm just assuming that goodwill at acquisition which you have calculated, goodwill at acquisition which you have calculated, that was 72 million. Please try to understand. It was a partial goodwill method. So whatever goodwill comes in a partial goodwill method, the entire goodwill only belongs to parent. But the problem is we are performing impairment test. And in impairment test, we have to compare carrying amount of subsidiaries net asset with the recoverable amount. But the problem is everything is logically 100% except the goodwill. Goodwill is actually representing what? 80%. So now you have to gross it up. You will have to gross it up. Your parent's holding is 80%, so 100 upon 80. If the parent holding was 70%, we would have multiplied this with 100 upon 70. So when it is a partial goodwill method and I need to perform impairment test where let's say I have to compare net asset of my subsidiary with the recoverable amount. So I have to gross up the goodwill. Let me just gross up 72 what happened to my calculator? 7200 upon 80. I'm getting 90. Assuming the carrying amount of net asset, I'm just assuming the carrying amount of net asset is coming, let's say, make it 260. The recoverable amount is, let's say, 220. Of course, there's an impairment loss of 40. Now, student, listen carefully. We have calculated impairment loss of 40, but number one, the entire 40 will not be recognized. Only what I'm going to do, I'll take 80% of this, which is 32, debit, credit, retained earning, P&L, debit by 32, goodwill. Now listen and listen carefully. Only when we are applying impairment test, when we are performing impairment review, in case of partial goodwill, you have to gross up the goodwill. After that, whatever the impairment loss comes, take that impairment loss, multiply by the parent's holding, and whatever impairment loss comes, that is only multiply by parent's holding, that will only be given to the parent. You are not going to do anything with the remaining impairment loss. So, and that is why, listen, if a discussion comes, a little bit discussion comes on full goodwill and let's say partial goodwill. So logically, the full goodwill is better than partial goodwill. Logically, why? Because in full goodwill, especially when the impairment loss comes, so that impairment loss is properly shared between parent and NCI. But when it comes to a partial goodwill, which is still acceptable, but the problem is in a partial goodwill, if the impairment loss comes, logically there will be impairment loss for NCI as well, but we will not be able to give them any share of impairment loss because we have initially recognized the goodwill only for parent. So a little issue comes when there's an impairment loss. I hope everyone has a now clear idea about this gross up issue. Is this clear to everyone, student? The difference when I'm performing impairment test when it is a full goodwill method, the difference when I'm performing impairment test when it is a partial goodwill method. Please comment so that we can go ahead. Student, even though it's just a grand lab revision class, I'm discussing each and every possible area so that you can get a really good revision. That's great. Basic working, of course, you will not be, we are not expecting to prepare entire SOFP, entire SOCI, and entire consolidated cash flow, but still you should have an idea. SBR exam will ask you to adjust a draft financial statement rather than prepare a full consolidated financial statement. However, you may still need to use some of the following working, then adjust a draft statement. Let's say Goodwill, there's this, just a format. I'll be explaining you, don't worry at all. Working one is the group structure. Basically, in group structure, what do? We just try to see which company is parent, how many subsidiaries are there, is there any associate? If parent is having 70% holding, so obviously NCI holding is 30. Parent is having 80% holding, NCI is 20. Group one, just working one, just the group structure. Student, working two is extremely important, which I really want to discuss. Let me make one more column. Post acquisition. That's my favorite. Otherwise, the difference of last two values, this and this, will give you the post acquisition. Okay, now at acquisition, at reporting date, equity share capital of, now this is net asset of each subsidiary. Why we are saying each subsidiary? Student, quickly reply. Why we are not just writing subsidiary? Why each subsidiary? Please, quick. What is the reason behind writing this each subsidiary? In SBR, obviously, it is very much possible that you are having more than one subsidiaries. Multiple subsidiaries are possible. Multiple subsidiaries are possible very much. That's why we have written each subsidiary. Share capital of at acquisition, share capital reporting date. Normally, in share capital, you will not see any difference. Most of the time, you have, I don't know, you have noticed or not, most of the time, examiner writes that after parent has got the control, subsidiary did not issue any shares. So at acquisition, at reporting date, share capital will be same. Other component of equity, now this is important. OC. OC could be different. Because in OC, there's a possibility, instead of writing a revaluation surplus, examiner has written other component of equity, which is possible. If the revaluation at acquisition is 100 million, at reporting date it is 120. So the difference is there in the revaluation surplus, which is possible. So there's a possibility that other component of equity will be different. There's a possibility. Retained earning, of course, that's going to be different. Now, fair value adjustment. This is important point. Student, look at this. It is not necessary that you will always have a positive fair value adjustment. Can I say the fair value adjustment could be negative as well? Fair value adjustment does not mean that at acquisition, the fair value of net asset of subsidiary will always be higher than the carrying amount. There's a possibility. There's a property, plant and equipment which is having a carrying amount of 100 million, but it has a fair value 90. Now there's a 10 million negative fair value adjustment. So there's a possibility that fair value adjustment could be negative. Most of the time it will be positive, but not necessary. Not necessary that it will always be positive. So fair value adjustment could be positive, could be negative. Post-acquisition accounting adjustment, unrealized profit on sale made by subsidiary. I want to discuss little more this point. Net assets of each subsidiary. Come here. Working to net assets of each subsidiary. At acquisition, at reporting date, post acquisition. I'm just bringing the data as well. Assuming this share capital is 100 million, everything is in millions, dollars, share capital. If there is a share premium, so of course I'll take the share premium. If there's no share premium, I will not take any share. Obviously, no share premium means no share premium. Assuming there's OC, other component of equity, instead of using the term revaluation surplus, assuming examiner has used OC, other component of equity, or you can say that revaluation surplus. Assuming 100, make it 50. It means in the post acquisition, there's a rise in the revaluation surplus by 10. Okay. The retained earning. Assuming the retained earning is, let's say, 200, 300. So in the post acquisition, there's a rise in the retained earning by 100. Now, please keep watching. At acquisition, there's a fair value adjustment. Now, fair value adjustment could be in a non-depreciable asset. For example, land, 50, 50. Okay. Fair value adjustment could be in a depreciable asset. Fair value adjustment in a property, plant and equipment. Assuming 100, keep watching. Now listen the next point. There's a fair value adjustment of 100 million. Fair value adjustment of 100 million in the property, plant and equipment, and at acquisition it was written. The remaining life of property, plant and equipment is 5 years. And we are consolidating after 1 year. So it means we have to recognize the additional depreciation of 1 year as well. Additional depreciation on fair value adjustment. 100 divided by 5, that will reduce the net asset at reporting date. So it means in the post acquisition, there's an additional depreciation of 20. Now please listen. Assuming examiner says there's a fair value adjustment in a building and fair value of that building is, assuming, okay, 90 million less than the carrying amount. Let's say the carrying amount is 500 million, but actually the fair value is 90 million less than the carrying amount. What I want to say, the fair value adjustment is not positive, it is negative. It is negative in a depreciable asset. Fair value adjustment. Building. 90 million negative. And let's say examiner has written in the question that at acquisition, the remaining life of the building is 10 years. At acquisition, the remaining life of the building is 10 years. Now, student, listen. Fair value adjustment is negative. Now, there will be a reversal of additional depreciation. Look at the first one. Let me change the color. Fair value adjustment of property, plant and equipment, positive, positive. So what we did? We went for additional depreciation on fair value adjustment. Now what I'm saying, the fair value adjustment in the building is negative 90. And at acquisition, it was written that remaining life of the building is 10 years. Look at this. Reversal of additional depreciation on fair value adjustment building, okay? Reversal of additional depreciation will increase net assets at reporting date. Student, please see the difference. When the fair value adjustment in a depreciable asset, it was positive. We charge additional depreciation expense, and that 20 actually reduced the net asset at reporting date. When the fair value adjustment was negative, then we went for the reversal of additional depreciation, and it has increased the net asset at reporting date. Okay. Now, one more thing. It is very much possible when parent is acquiring a subsidiary It is very much possible. When parent is acquiring the subsidiary in individual books of subsidiary, according to IAS 37, there is a disclosed contingent liability, which is perfectly fine because it is IAS 37, which says that if you have a contingent liability, you need to disclose, and subsidiary did something very right. Okay. And let's say in individual books of subsidiary, the disclosed amount of contingent liability is 40 million. Okay. But at acquisition, the parents, directors, they are saying fair value of that contingent liability is 60 million. What they are saying? The fair value of the contingent liability is 60 million. Now, students, listen and listen carefully. In group accounts, I will take that as a liability. I will not ignore it. It's just a normal, I would say, concept. You are acquiring a business. Why would I ignore your contingent liability? No, I will not ignore it. So if the directors are saying that fair value of the contingent liability is at acquisition, let's say it is 60 million. Okay, at acquisition it is 60. Listen, student, what I'm going to do. I will take that as a fair value adjustment. Let's say this is my liability. And this 60 will not increase my net asset. It will decrease my net asset. So what I want to say. Now it is very much possible that in individual books of subsidiary, the disclosed contingent liability amount is different. And the amount of the contingent liability, which as a liability we are recognizing in group account, the value is different. Okay. Another point. Intra-group trading of goods. It could be intra-group trading of inventory. It could be intra-group trading of property, plant, and equipment. If subsidiary is the seller, only then unrealized profit on stock, URP on stock, unrealized profit on stock. Subsidiary is the seller. Unrealized profit on the stock when subsidiary is the seller will be deducted from the net asset at reporting date, assuming it is 10 million. It is not necessary that subsidiary has sold the stock. It is possible subsidiary has sold the property, plant, and equipment. Unrealized profit on plant and machinery. Again, seller is the subsidiary. Let's say 20. So unrealized profit on stock, unrealized profit on plant and machinery will only be deducted when subsidiary is the seller. Subsidiary is the seller. That's very important. Okay. Now, whatever values comes. How do we calculate the value of unrealized profit? Now, this is also important. For example, in individual books of subsidiary, the value of the stock is 100 million. Subsidiary has sold this to parent for 120 million. An examiner says 40% of the stock is unsold. Now, student, listen carefully. Unrealized profit is only within the remaining stock. Unrealized profit is only within the remaining stock. So it means unrealized profit will be 20 into the total profit was 20. But since unsold is 40%, so I'll take 40% of that, which is 8. Okay, I have a question I want everyone to answer. Subsidy, seller, parent of course buyer, carrying amount of property, plant and equipment, 100 million, sold for 140 million, 125. Okay. Remaining life, remaining useful life, 125, 10 years. We are preparing group accounts on December 25 after 12 months. Acquisition period is 1 year. What is the unrealized profit amount? Just give me the URP amount, please. Quickly, student. Subsidiary has sold a plant carrying amount 100 million, sold it to the parent for 140. Disposal date is 1/1/25. We are preparing group accounts on December 25. My question is, give me the value of unrealized profit. Be quick, students. What is the value of unrealized profit? I can just give you a hint. The hint is, okay, let's see what is the answer. Come on. Absolutely incorrect. It's just not incorrect. The answer is absolutely incorrect. Whatever others, I can just give you one hint. The hint is unrealized profit is within the remaining life. Keep the remaining life and remaining life on the day when you are remaining life, the day you are doing the consolidation. Okay, now I think we should do it together. Look at the carrying amount is 100. Sold it for 140. Can I say in individual books of subsidy has recognized the profit of 40 million? Yes or no? On 1/1/25, subsidy has recognized the profit of 40 million. Look at this. Unrealized profit on plant and machinery. 40 million multiply by. Take the remaining life on the day of disposal. It was 10. Now we are doing adjustment on December 25. Can I say 1 year has been passed? So how many years are left? Yes or no? So unrealized profit is, how did I calculate this? Divided by the life at the time of disposal, multiplied by the life at the time when we are doing consolidation. You will directly get unrealized profit. Is this clear? The same concept which was on a stock. The 40% of the stock was unsold, so unrealized profit was within the 40% of the stock, unsold stock. That if you look at this mathematically, I can say that 90% of the life is unused. When it was sold, you can say the life was 100%. The day we are doing consolidation, the life unused life is 90%. Is this clear how to calculate unrealized profit in case of plant and machinery? For example, the same example, and we were doing consolidation after 2 years. For example, acquisition period is 2 years. So 40 divided by 10 multiplied by 8. I hope it is clear now. Numerator, what comes in the numerator? The remaining life, the day when you are doing consolidation. Denominator, the remaining life at the time of disposal. Student, please. Is this clear so that we can go ahead? Waiting. Please, you have to be a bit quick. Okay. I'm selling on this day. Disposal date. I'm saying the remaining life on disposal date is 10 years. You people are doing consolidation on December 26. The day subsidy sold, the disposal date was 1/1/25. You are doing consolidation on December 26. It means if I ask you the acquisition period, can I say logically the acquisition period of the subsidy is 2 years? Yes or no? Let's say 1/1/25, parent has acquired the subsidy on the same day subsidy is sold asset to the parent, and we are doing consolidation on December 26. So the acquisition period is 2 years. Subsidy had a plant and machinery with a carrying amount 100 million, a remaining life 10 years, sold it to parent for 140 million. So subsidy the seller, parent the buyer. In day one, subsidy has recognized the profit of 40 million. But we need to eliminate unrealized profit. In group accounts, we need to eliminate unrealized profit. So how much profit you will eliminate? Unrealized profit on plant and machinery. I've taken the entire profit 40 million, multiply by. We are doing consolidation on, let's say, December 26. Acquisition period is 2 years. So can I say, since the date of disposal, which was 1/1/25, till December 26, 2 years have been passed. So what I'm doing? Divided by 10. 10 means life at the date of disposal. Life at the date of remaining life at the date of disposal was 10. But can I say the remaining life at the date of adjustment is 8? I'm getting the unrealized profit. So here, the remaining life, remaining useful life at disposal. Remaining life at, you can say, adjustment date. Or when we are doing remaining life at, when we are doing what? Consolidation. When we're preparing consolidation books. So we are doing we are preparing group accounts on December 26. So remaining life at the date of adjustment. I hope it is clear now. How to calculate unrealized profit in a plant and machinery? You have to just see that after the date of disposal, how many years have been passed. So unrealized profit will be in the remaining life. Is this clear, student? Numerator, take the life. How much is left? Denominator, useful life at the date of disposal. Now come here. Net assets of subsidiary. After that, goodwill. Fair value consideration, NCI acquisition. Fair value net asset, this you will get from working to. Goodwill at acquisition, if there is any impairment loss, I'll deduct that. You will get goodwill. Now listen carefully. If goodwill at acquisition, this comes negative 40 million, I'm assuming. It is not necessary that all the time you are having a positive goodwill. Can I say negative goodwill can also arise? Yes or no? Please reply. Is it necessary to have the positive goodwill always when you are doing consolidation? There's a possibility to have negative goodwill as well. Now listen. Instead of positive, if you are having a negative goodwill, this negative goodwill means gain on bargain purchase. If there's a negative goodwill, so actually negative goodwill at acquisition, negative goodwill at acquisition means gain on bargain purchase. Now listen carefully. If there's a negative goodwill, which is a gain on bargain purchase, listen, the entire gain belongs to parent, no matter it is a partial goodwill or full goodwill. It will increase the parent's retained earning, it will increase the parent's profitability. Repeat. If the negative goodwill comes, obviously, in case of negative goodwill, there's no question of impairment. It does not make any sense. If there's a negative goodwill at acquisition instead of positive, the entire negative goodwill, another name is gain on bargain purchase. The main concept is either it is a partial goodwill method or a full goodwill method. Whatever the amount of the negative goodwill is, entire negative goodwill belongs to the parent, because parent is the one which has acquired the subsidiary, not the NCI. So the entire gain on bargain purchase belongs to the parent. It will increase the profitability retained earning of the parent. Is this clear to everyone? Please quickly reply, because we are heading towards a break. Okay, that's clear. After that, we'll go for NCI. NCI at acquisition, post acquisition, share in the post acquisition reserves. Look at this. NCI percentage of goodwill, but it is only if there's an impairment loss, that impairment loss share will be given to NCI, but it will only be given to NCI when it is a full goodwill method. In partial goodwill, we have already discussed entire loss belongs to parent. After that, students, group retained earning, everything. But we have to take a break, and after the break, we will resume the class. Okay, students, let's resume the class. Step 5, we need to calculate group retained earnings, parents retained earning, group share of post acquisition retained earning, which you will get from the working to, less if there is any impairment loss in the goodwill, and we will deduct unrealized profit if parent is the seller. We'll deduct unrealized profit if parent is the seller. Another point, if it is a negative goodwill, as we have already discussed, negative goodwill means gain on bargain purchase, then simply gain on bargain purchase will be added. That gain actually belongs to parent and it will increase the reserves. So if there is a negative goodwill, so that is gain for the parent, and negative goodwill gain on bargain purchase will be added to the retained earnings. Okay. Another thing is, when we say goodwill impairment, so share of goodwill impairment loss will only come if it is a full goodwill method, because in case of partial goodwill, entire impairment loss in the goodwill belongs to parent. Then there will be no question of share of impairment loss in the goodwill. So for example, it is a full goodwill method, parent is having 80% holding, then whatever is the impairment loss, 80% will be given to the parent. But if it is a partial goodwill, entire impairment loss will be given to the parent. Now, if there is any OCE, other component of equity, so we will be doing calculation separately. Parent companies, other component of equity from parents SOFP, and then if there is any change in the post acquisition OCE, if you look at the format I did discuss, like OCE, which is a lesser revaluation surplus, there's a change of 10 in the post acquisition period. So this 10 multiplied by parents holding. So parents, company OC, and then share in the post-acquisition OC. Consolidated profit and loss and other comprehensive income. We'll add revenue of parent, subsidiary, cost of sale, and this, that. Okay. How do we calculate value of NCI in case of P&L? We'll take subsidiaries profit after tax. If you have acquired the subsidiary during there, then obviously PAT will be time apportion. Less unrealized profit in the stock if subsidiary is a seller. Additional depreciation amortization on fair value adjustment will be deducted. Goodwill impairment loss under fair value model only. Whatever is the impairment loss in the goodwill, that will be deducted if it is a full goodwill method. Then, assuming it is 80, and let's say NCI holding is 20%, then 20 into 80%, that is 16 will be profit attributable to NCI. In case of other comprehensive income, that is, we have to give share to the NCI in the profit as well as into total comprehensive income. Again, I'll take the total comprehensive income of my subsidiary. If you acquire the subsidiary during there, so it will be time apportion. Unrealized profit, if subsidiary is the seller, will be deducted. Additional depreciation, goodwill impairment, again under fair value model. Assuming it is 90. So 20% of 90 is 18. So we will give share to the NCI into subsidiaries profit after tax as well as total comprehensive income. I hope everyone has joined the class. Let me just see. Is there any message in the WhatsApp group? Okay, let me just. Class has. Okay, fine. Associate. Again, very important discussion on associate. Number one thing is we do not consolidate associate. Number one thing is we just did the format, nothing else. Don't worry at all. Just this format. How do we calculate NCI from for the P&L? We'll take subsidiaries PAT, then unrealized profit will be deducted, additional depreciation will be deducted. In case of full goodwill method only, impairment will be deducted. Now the main thing is associate. Now listen, student. Number one concept is we do not consolidate associate. What do you mean by this? Actually, when we say consolidation, it means to merge the financial statement of different entities when there is a relationship of parent and subsidiary. What do we do in consolidation? Property, plant, and equipment of parent will be added with the subsidiaries property, plant, and equipment, or subsidiaries, they will be added with the parent. But in case of associate, we are not going to add associate property, plant, and equipment with the parent. We can't do that. We do not consolidate associate. Associate books will not be merged with parent books, but still there will be an accounting. The name of that accounting is equity method. IAS 28 investment in associate and joint venture defines an associate an entity over which the investor has a significant influence. Normally, significant influence can be seen through a directorship chair. For example, if parent is having a 25% holding in XYZ company, in addition to that, parent is also having one of the directors in that company is sitting due to the parent's holding and because of the parent. So basically, directorship chair shows the significant influence. And normally, if nothing is mentioned, the holding is between 20 to 50, then we normally assume investee company is an associate for us. Significant influence is the power to participate in the financial operating decisions of an entity. So associate means where parent is having a significant influence, normally which can be seen through a directorship chair. A holding between 20 and 50 of the voting power is presumed to give us significant influence. So normally when you have holding between 20 to 50, we assume that you have a significant influence. Accounting for associate. Associates are accounted using equity method. Statement of financial position, that is cost of investment, add share of increase in the net assets. Simply you add share in the post reserves of associate, but multiply by whatever is the share in whatever is the increase, whatever is the reserve in the post acquisition, multiply by parent's holding. That is why we are saying share of increase in net assets. Less impairment losses. If there is any impairment loss in associate, that will be deducted. Okay, now you will have an investment in associate. So how do we calculate the carrying amount of investment in associate? First of all, we'll take cost of investment of parent, cost of add share in post reserves. Now, very important point. If your associate has given the dividend, if associate has given the dividend less dividend from associate, we'll see this with the help of a T account as well. If parent has received the dividend from associate, that will reduce the carrying amount of investment in associate. Less if there is any transaction. If there is any transaction, let's say, I'm assuming, okay, that associate and parent. There's an unrealized profit in case of parent and associate, assuming parent has sold goods to the associate. If parent has sold goods to the associate and there are some there is 30-40% unsold stock, unrealized profit is always in the remaining stock. So when parent has sold the stock to the associate, then we have to deduct the unrealized profit less unrealized profit on stock. If there is any impairment loss, in case of impairment loss, examiner will give you the recoverable amount of investment in associate. All you need is just compare the carrying amount of investment in associate with the recoverable amount. Difference will be your impairment loss. For example, you have calculated 200 and examiner says the recoverable amount of investment in associate is 190. If this is the case, then impairment loss is 10. Because when carrying amount is more than the recoverable amount, so the difference is impairment loss. Now there's question why dividend from associate is actually reducing the carrying amount of investment in associate. Let me explain that. Come here. Investment in associate. Obviously, investment in associate is my asset. Brought down, carried down. Okay. Let's say, when obviously in the post acquisition, when my associate is generating any profit, I will get a share of that profit. Due to share of that profit, my investment will increase. Share in let's say associate PAT. I'm assuming in the post acquisition period, associate has generated a profit of 100 million. Parent is having a 30% holding, so it will be 30. It is not necessary that only examiner gives you the information of PAT of associate. There's a possibility in the post acquisition. There's a revaluation surplus in associate. So we will take share in OCI as well. Share in associate other comprehensive income, assuming it is 50. 30% of that is 15. Okay. Now please try to understand. We are taking share in PAT. We are taking share in PAT. Obviously, both sides must be equal. I'm assuming it is, I'm just assuming, okay, values. Let's say it is just an example. Let's say it is, make it 60. Okay. Assuming examiner says the CD is, let's take it 50. Now, the question is, during their, your associate has given you the dividend as well. So dividend receive from associate, let's say there's a balancing figure, which is 10 in my example. Now try to understand. Your subsidiary has given you the dividend. So dividend means distribution of profit. Look at this. We have already taken the share in profit after tax, which is 30. Your subsidiary has given you the dividend. So obviously, dividend, when your associate has given you the dividend. Due to dividend, what happens? The retained profit of the associate will reduce. Due to dividend, retained profit of the associate will reduce. So simply, if your associate has given you the dividend, then your double entry is cash or bank debit, investment in associate credit. So logically, your share in the PAT is 30, but out of that 30, you can say that 20 you have received in the form of dividend. My share in the PAT is 30 million, but out of that 30, logically, I have received 10 million in the form of cash, in the form of dividend. So logically, my investment should increase by a net amount of 20. That is why, please look what is happening. Your carrying amount of investment in associate is increased by 30, but it has reduced by 10. So the net impact is increase of 20. Just imagine that there's an investment in XYZ company, which is your associate, and that has generated a profit of 100 million, 30% belongs to you, and you have increased your investment by 30 million. The double entry of that 30 is investment in associate debit, retain earning profit, your P&L credit. But that company has given you the 10 million in the form of cash. So I'm going to debit the cash and I will credit my investment in associate by this 10. So the double entry of 10 is cash or bank debit, investment in associate credit. Now come here. Profit or loss include the group's share of associate PAT after tax less if there is any impairment loss in the current year. Joint arrangement, IFRS 11. Joint arrangements are defined in IFRS 11. Joint arrangement as arrangement where two or more parties have joint control. This exists when relevant activities require unanimous consent of the parties that share control. Unanimous consent. Everyone will have to say either yes or no. If everyone is saying yes, only then that particular decision will be taken. Otherwise, we cannot take that decision. When we say joint arrangement, there are two possibilities. One is joint operations. Ventures have a right to assets and obligation of the arrangement. Account for the share of asset, liabilities, income, and expenses. Joint operations. Joint operation means, for example, we have APLC and we do have BPLC. Okay. There's an oil well. Assuming APLC and BPLC jointly, they have constructed, they have developed this oil well, they have invested together in this oil well. I'm assuming 60% of cash is coming from APLC, 40% is coming from BPLC. Assuming the total amount, take it 100 million for the simplicity. Number one, they have constructed this oil well. Total amount is 100 million, 60% paid by APLC, 40 paid by BPLC. In SOFP of APLC, 60% of this 100 million will be shown in the non-current asset. How much? 60%. Second, obviously, when we are going to operate this oil well, we have to bear the expenditure as well. All the operating costs will be shared between A and B on the basis of 60 and 40%. Third, if there is any obligation relating to oil well, for example, the decommissioning cost at the end of useful life of this oil well, we have to dismantle it. So whatever is the amount of that provision, 60% will be recognized in A books and 40% in B books. Okay, another point is the revenue. From this oil well, the 60% revenue will be in the books of APLC and 40% revenue will be in the books of BPLC. So if this is happening, it means we are dealing a scenario of joint operations. So in joint operations, what happens? There will be you will not be having any separate entity. There will be a jointly controlled asset. Another example could be assuming you and your friend, you both bought a piece of land together. One has, let's say, invested 55%, another has invested 45%. Okay, but the arrangement is a joint arrangement in which it is written that if there is any obligation on land, 55% you have to bear, 45% your friend is going to bear. If there are any expenses, 55% belongs to you, 45% belongs to your friend. So it means we are dealing with the joint operations. So in joint operation, what happens? Venturers have rights to assets and obligation of the arrangement, account for share of asset. Like in my oil well example, I was taking everything 60% of assets, 60% of liabilities, 60% income and expenses. Now come here. In joint arrangement, the second area is very important, joint venture. Venturers have the right to net asset of the arrangement, net asset. A joint venture is normally a separate entity. In that case, we'll go for equity accounting, same as associate. For example, APLC, assuming BPLC, we have CPLC, and let's say we have DPLC as well. Assuming A is having 30% holding, 30% holding, and 40. A, D, and C, they all made an agreement In that agreement, there's written that let us control jointly the BPLC. There's an agreement between APLC, DPLC, and CPLC. This agreement could be between A and D. But assuming there's an agreement between A, D, and C. An agreement says that we are going to control BPLC jointly. And due to this joint venture, what happens? The accounting which A, C, and D they will be following, they will go for equity method. In equity method, we will be doing the same accounting like we do in associate. Even though there is a difference between associate and joint venture, in joint venture, decision will only be taken when there's a unanimous consent between all the investors. In case of associate, we just go look one thing, which is significant influence. But when it comes to accounting, in case of accounting, the concept is accounting for joint venture and accounting for associate is same. But there's a slight difference between the concept. Joint venture means unanimous consent. If there's a unanimous consent, only then particular decision will be taken. Otherwise, decision will not be taken. That is the meaning of unanimous consent. And in case of joint venture, you will see there is an agreement between parties that we are going to control the jointly controlled entity together. Now, disclosures, IFRS disclosures. For the disclosure, we go for IFRS 12. IFRS 12 outlines the disclosure requirement between one entity has an investment and another. Okay, this is very important. IAS 27, separate financial statement. I have taken only the main area, which is very much relevant. IAS 27, separate financial statements. IAS 27 applies when an entity has interest in subsidiaries, joint ventures, or associate, and it prepares separate non-consolidated financial statements. In separate financial statement, investment in subsidiaries, joint ventures, or associate can be accounted for in the following ways. This is now very important. It has been also examined once. Simply, parent in individual books. What are the options available? Parent can keep the investment at cost in individual books. Second, in accordance with IFRS 9 financial instrument, parent can keep the investment by using IFRS 9, that is fair value through P&L or fair value through OCI. The last one is equity method. Now, this is very important. In individual books of parent, there are three options available to the parent to keep the investment in subsidiary, joint venture, or associate. That's very interesting. In individual books, parent can keep the investment at cost, no matter it is a subsidiary, joint venture, or associate. In individual books, parent can apply IFRS 9, keep them at fair value through P&L or fair value through OCI. We know that in case of following fair value through OCI, you will have to make an irrevocable election. We know all those things. But the important point is in individual books, there are three options. And the last one is equity method. So don't forget one thing. In individual books of parent can keep the investment in subsidiary, joint venture, or associate one way out of three. One is keep at cost. Second is in accordance with the IFRS 9 financial instrument. And the last one is equity method. Now, let me tell you one very important point, okay? Please, let's say we are talking about subsidiaries. Parent investment and subsidiary, obviously, there are three options available. In individual books, parent can keep the investment in subsidiary at cost, fair value under IFRS 9 or using equity method. Now, please try to understand. Assuming I'm talking about parent investment in subsidiary. The cost of investment in subsidiaries, let's say 80 million. If same investment, instead of cost, if we keep at fair value under IFRS 9, let's say the value will be 100 million. Assuming if the same investment in subsidiary in individual books, if parent goes for equity method, the value will be, let's say, 95 million. Wow. I'm just giving you an idea. Investment of parent in subsidiary. In individual books, parent is having three options. Parent can keep the investment at cost, assuming which is, if it is the case, 80 million. Parent can go for IFRS 9, fair value through P&L or OCI, whatever it is, assuming the fair value is 100 million, and using equity method, assuming the value is 95. Now, please try to understand. When we prepare group accounts, group accounts are always made as parent has kept its investment in subsidiary at cost. Repeat. Group accounts are always prepared as parent has kept investment in subsidiaries in individual books at cost, which means that even the examiner is mentioning that in individual books, parent has kept investment in subsidiary at fair value under IFRS 9 and the fair value is 100. But examiner has also mentioned original cost is 80. So while preparing group accounts, I will work on 80. When you will be calculating cost of investment, step 3, when you will be calculating a goodwill, cost of investment in subsidiary, I'll take 80 million. Now there's one question. Assuming in individual books, parent is following IFRS 9, and let's say fair value through P&L. Examiner has mentioned in the question that cost of investment is 80, but in individual books, parent is following IFRS 9, fair value through P&L. Obviously, when we'll be preparing group accounts, so instead of 100 million, I'll take the cost of investment 80. Number one, while calculating goodwill, the cost of investment will be 80. Number two, student, listen. Number two, when we will be calculating retained earning. So in the individual books, of course, if you look at this, cost is 80, the fair value is 100. Can I say in individual books, parent has recorded the gain of 20 million because investment has increased from 80 to 100. So while calculating group retained earning, the gain in individual books which parent has recognized 20 million, that will be eliminated. Why it will be eliminated? Please look at this. When we calculate retained earning, group retained earnings, what do we do? We take parents' retained earning. Now, whatever it is, can I say the parents' retained earning will have the impact of rise of investment of 20 million? Yes or no? Please reply. I'm taking parents' retained earning from the individual books of parent. And in individual books, parent has kept the investment at fair value. When parent bought the investment, parent bought it for 80, now it has a fair value of 100. It means in individual books of parent, the gain of 20 million is already recognized, and that 20 million has increased the retained earning of parent. So while calculating group retained earning, that 20 million will be deducted, less gain on investment. In my example, it went to 100 from 80. But student, this issue will only arise if parent has kept investment in subsidiary in individual books at fair value instead of cost. Is this clear to everyone? Please reply. Is this clear? That in while calculating group retained earning, you have to eliminate that gain, which parent has recognized in their individual books. Okay, now there's one more issue. Now listen. If instead of fair value through P&L, what if parent was following fair value through OCI? If this is the case, as we have seen the format, we do calculate OCE as well, other component of equity. So you will take parents OC less gain on investment. That is 100 minus 80. So it is very important that you should know this. If parent has kept the investment in subsidiary in individual books at fair value, which parent can do that, but you need to then properly read the question. In individual books, either parent is following fair value through P&L category or OCI. In case of fair value through P&L, so whatever the change came in the fair value, it will be deducted. If there's a gain, so gain will be deducted from the group retained earning. If there's a loss, loss will be added. It is not necessary that fair value of investment will always be higher than original cost. Fair value of the investment could be lower than the original cost. So if there's a loss in the fair value, it will be added while calculating the retained earning. But if parent says we are using IFRS 9, but the category is fair value through OCI, then change in the fair value will be adjusted into OCE, other component of equity. Now let me share the second handout of consolidation. And this will also be uploaded with the video, okay? You will get this PDF relating to the consolidation. Okay, students, let's start another area of consolidation. The revision is going on, the grand live revision class, I would say. Change in the group structure. And let me tell you, I think majority of the students, they know that as well. We are conducting these live revision classes in each and every paper. Either it is skill level or professional, every paper means every paper. Okay, change in a group structure. These are the few more steps which you need, concept which you need to know. One is step acquisition, disposal of subsidiary where control is lost, presentation of disposal, control to control scenario. Step acquisition. Step acquisition means, can I say, getting the control in a subsidiary in stages. Step acquisition means acquisition of a subsidiary in stages. But goodwill will only be calculated when parent has got the control. Okay. Consolidation will start the day parent acquired the subsidiary, means parent got the control in subsidiary. A step acquisition occurs when the parent company acquires control over the subsidiary in stages, because there is a possibility initially parent was having 20% holding. After that, parent went for 35 more, so becomes more than 50. There's a possibility initially parent was having 10%, then parent got 20, then again 25, something like that. Acquisition accounting is only applied at the date when control is achieved. At the date control is achieved, this is now the accounting is very important. Remeasure the previously held equity interest to fair value. Remeasure the previously held interest to fair value. You need to see what is the fair value of previous holding at the date of control. What is the meaning with the first one? You need to see what is the fair value of previous holding on the day of control. Recognize any resulting gain or losses in profit or loss for the year. And look at this. Or in OCI, if the shares were at fair value through OCI category. Extremely important concept, students. Number one, the day you are getting a control, check what is the fair value of previous holding. Assuming the carrying amount of previous holding is 10 million and fair value is 12. So there's a difference of 2. Where should I take that difference of 2? Should I take that to the P&L or OCI? It depends how you were carrying the previous 10 million. If previous holding was under fair value through P&L category, then 2 million will go to P&L. If previous investment was in individual books at fair value through OCI, then this 2 goes to OCI. One more possibility, and let me answer that. Now there's a question, sir, what if previous holding was under equity method? It's okay. Even the previous holding was under equity method. First of all, you need to know what is the carrying amount of investment in associate at the date of control. Repeat. If the previous holding was under equity method, so first of all, you need to know what is the investment in associate carrying amount on the day of control. Carrying amount, compare that carrying amount with the fair value. Difference will go to P&L. Calculate the goodwill and non-controlling interest. For the purpose of goodwill calculation, use the following: perform a fair value of the previously held interest, simply fair value of your previous investment, fair value consideration of the additional interest, NCI at acquisition, then we'll deduct fair value of net asset at acquisition. Difference is going to be your goodwill at acquisition. Now, if the sale of shares causes, now this was the step acquisition. Now let's talk about disposal of the subsidiary. Disposal of shares in subsidiary. Okay. Disposal of shares in subsidiary, there are different possibilities. Number one, the control is lost. Number two, let's say one possibility, you have sold 100% of your subsidiary. Second, the subsidiary becomes your associate. Third, let's say the subsidiary becomes your trade investment. And there's one more possibility, subsidiary is still subsidiary. For example, earlier parent was having 80% holding, now parent has sold 10%. So parent becomes at 70. Control is still there. So disposal of shares in subsidiary, there are possibilities. Number one, 100% sold. Second, becomes associate, joint venture, it is very much possible. Third, becomes trade investment or just an investment. Associate, I'll be using IAS 28. Investment, I'll be using IFRS 9. And final possibility is still subsidiary. From 80, if my holding becomes 70, so my company will still remain the parent. Now look at this. In first three situations, logically the control is lost. If you sell entire holding, if subsidiary becomes associate or subsidiary becomes a normal investment under IFRS 9, in first three situations, the control is lost. But still subsidiary means control is retained. A very basic and important concept is when control is lost, then whatever gain or loss comes, that will go to P&L. When control is lost, whatever the gain or loss comes, that will go to P&L. Another point is there will be no consolidated SOFP. Because SOFP is as at, obviously when the control is lost, You cannot prepare consolidated SOFP, but still, we will be preparing a consolidated SOCI. For example, during the you kept the subsidy for 9 months, after that control is lost. So the P&L of subsidy will be obviously consolidated for 9 months. So important point is, in first three situations, the control is lost. Whatever the gain or loss comes, that goes to P&L. Still subsidy. In case of a still subsidy, whatever the gain or loss comes, that will go to OCE, other component of equity. Let's see. If the sale of shares causes control over a subsidy to be lost, then treatment in the consolidated financial statement is as follows. Consolidate the income and expenses of the subsidy up until the disposal date. On the disposal of subsidy, de-recognize its asset liabilities, goodwill, and non-controlling interest, and calculate what profit on or loss on disposal. Recognize any remaining investment in the share of former subsidy at fair value and subsequently account for this under the relevant accounting standard. As I mentioned, there's a possibility after investment it becomes your associate, then subsequently you will follow IAS 28. There's a possibility after disposal of shares in the subsidy, remaining holding is just 5-10%. That is your normal investment. We'll go for IFRS 9. A holding of 20 to 50 of the share would probably mean that remaining investment is an associate which should be accounted for using equity method. But holding less than 20 of the share would probably mean that remaining investment should be accounted under IFRS 9. Now the format of calculating gain or loss is very important. Disposal proceed. Fair value of the retained interest. Fair value of the remaining holding. If you have, obviously, if you have sold all of your holding in the subsidy, then there will be no fair value of the retained interest. So fair value of the retained interest means fair value of the remaining investment. And this is very important. We are not saying cost of the remaining investment. We are saying fair value. So please, student, remember one point here, a very important concept. What is that? We are taking disposal proceed. After that, we are saying fair value of the remaining investment. Now listen and listen carefully. Final, whatever the gain or loss comes, logically, that gain or loss on disposal will actually does not only relate to the portion which you have sold. It does not belong to only the disposal proceed. Logically, your final gain or loss will also have the impact of the holding which you have retained. Why? Because look at this. We are taking fair value of the remaining investment. We are not taking the cost of the remaining investment. We are not taking the carrying amount of the remaining investment. We are taking the fair value of the remaining investment. It means that the final gain or loss will be the gain or loss on the overall holding of parent. For example, parent had 80% holding and 60% it is sold. Now, examiner has asked you a question of 2 marks. The question is, sir, examiner is asking you that whatever the gain or loss comes from disposal, will it only represent the 60% which parent has sold? The answer is no. The gain or loss on disposal logically represents the entire holding of parent. Because we are not taking only disposal proceed, we are also taking the fair value of the remaining investment. Just imagine that in individual books, the carrying amount of the remaining investment is 8 million and the fair value of the remaining investment is, let's say, 15. So here I'll be taking 15. So let me repeat, whatever the gain or loss comes, it actually does not belong to only the portion which you have sold. It also belongs to the portion which you have retained. What is the logic behind that? Because we are taking fair value of the remaining investment. Now, less interest in the subsidy dispose of. Net assets of subsidy at disposal date. Goodwill at disposal date. Why we have written goodwill at disposal date? There's a possibility due to impairment loss in goodwill. There's a possibility there's zero carrying amount of the goodwill. So simply you just need to see, is there any goodwill at disposal date? If you have, because due to impairment losses, there's a possibility that entire goodwill is already written off. But again, if you still have any goodwill, so take that goodwill at disposal. Less the carrying amount of NCI. Basically, if it is 100 million, it is 20. And let's say NCI at disposal is 40. So from here, I'll be deducting 80. So net asset of subsidiary at disposal date, goodwill at disposal date, less carrying amount of NCI at disposal date. Whatever the gain or loss comes, that goes to group P&L. Presentation of disposal. If a subsidiary is acquired exclusively with a view to subsequent disposal and it meets the held for sale criteria under IFRS 5, it is presented in the financial statement as a disposal group, classified as held for sale. This is achieved by amalgamating all assets into one line and all liabilities into one line. Simply, disposal group assets, we will show them in under current asset. Disposal group liabilities, will show them under current liabilities. It is measured both on acquisition and subsequent reporting date at fair value less cost to sell. But this is very important, presentation of a disposal. If a subsidiary is acquired exclusively with a view to subsequent disposal and it meets the held for sale criteria. Student, can you tell me 1 or 2 points of the criteria of IFRS 5? Let's see who remembers. Criteria of IFRS 5. Obviously, before applying IFRS 5, non-current asset held for sale and discontinued operation criteria must be met. So give me at least 2 points. There are more than 2, but I want at least 2 points. Student, quickly tell me the criteria of IFRS 5. Number 1, should be saleable in its present condition. Remember, should be saleable in its present condition. Number 2, seller should be quoting a reasonable price. Student, what is the meaning of reasonable price? Can you tell me what is the reason of reasonable price? Examiners, IFRS says seller should ask for the reasonable price. What do you mean by reasonable price? Just an example, okay? If there's a car which has a value of, let's say, 1 million, assuming the current value is 1 million. If the seller is asking 1.5 million, is it reasonable to ask 1.5, even though the market value is 1 million? No, obviously no. Then criteria will not apply. So you should be quoting the reasonable price, means according to the current value. Look at the situation of your asset, then you'll be asking. Another point is management should be committed to sell it. Sale should be highly probable, means within 12 months after applying the IFRS 5, it should be sold. So student, please, you need to know the criteria, and management should be committed to sell. Of course, they should be engaged in activities to find the buyer. Okay, now come few more important concepts. Control to control scenario. Share purchases. Some share purchases simply increase the parent's holding. Let's say from 80 it becomes 85. From 70 it becomes 80. In such cases, look at this. Goodwill is not recalculated. From 80, the 80% holding to 85. That's a control to control scenario. Into control to control scenario, we'll be just calculating gain or loss, and whatever the gain or loss comes, that will go to OCE. So goodwill is not recalculated. A profit or loss does not arise in consolidated financial statements. Okay. The entry in the group accounts. Debit non-controlling interest. Why? Parent was having 80% holding, so holding of the NCI was 20. If parent holding becomes 85, can say NCI reduces to 15. So NCI reduces, so NCI will be debit. Cash will be credit. As I mentioned, whatever the gain or loss comes, that will go to other component of equity. That will even not go to OCI, that will go to OCE. So non-controlling interest, debit, cash, credit, and if there is a loss, then OCE debit. If there's a gain, OCE credit. The decrease in NCI is calculated as the proportion reduction in its carrying amount at the date of group's additional purchase of share. This is very important. Let me explain numerically. Parent holding is 80, NCI holding is 20, and we are buying 5% holding from NCI. What do you have to do? The day parent is buying additional 5% holding from NCI, first you have to calculate the value of NCI at that date. Let's say value of NCI is 50 million. The day parent is buying additional 5% from NCI on that day, value of NCI on that day is 50. NCI value is 50 million. Okay. Now listen. In my example, 20% is the holding of NCI. The value is 50 million and we are buying 5% from NCI. Look at this. 50 multiplied by 5 divided by 20. This 50 million is representing 20% holding of NCI. And we are getting 5% more from NCI. So 50 multiplied by 5 upon 20. I'm getting 12.5. It means logically, NCI will be debited by 12.5. Let's say parent has paid the cash 15. So OCE, there's a loss on further acquisition which is 2.5. If parent has paid less than 12.5, so gain on OCE we will credit it. The main concept is when we are buying more holding from NCI, first you need to calculate what is the value of NCI. Then look at this. The decrease in NCI is calculated as the proportion reduction in its carrying amount at the date of group's additional purchase. Now come here. Sale of shares. Opposite of the first one. Parent is having 80% holding. NCI is having 20%. Now parent is selling 5%. Parent becomes 75. NCI becomes 25. Now look at this. In such instance, goodwill is not recalculated. Again, whatever the gain or loss comes, there will go to OCE. This time, parent is not buying additional shares, just parent is selling some of the shares. A profit or loss does not arise in group accounts. Okay. The entry, cash debit, NCI will be credited. NCI is increasing. Why? Look at this. Parent's holding was 80, NCI was 20. Now parent holding has become 75. So NCI holding from 20, it has become 25. That is why NCI will be credited. The balancing figure. If it is a gain, OCE will be credit. If it is a loss, OCE will be debit. But there's one thing which is very important. How do we calculate value of NCI? The increase in NCI will be the share of net assets always. The increase in NCI will be the share of net asset always and goodwill fair value method only. The issue of goodwill will only come when it is a full goodwill method of the subsidiary at the date of disposal, which the parent effectively sold to NCI. Let me explain. Come here. Let's say parent is selling 5% holding to NCI. At disposal, net assets of subsidiary, let's say they are 80 million. Net assets of subsidiary at disposal, they are 80 million. Let's say take 5% of this. How much? 4. If it is a full goodwill method, that's very important. Okay, please you should. If it is a full goodwill method, take goodwill also at disposal when parent is selling it. Let's say we have a goodwill of 20. Take 5% of this. We'll get 1. Let me repeat. The issue of goodwill will only come if it is a full goodwill method. NCI value will increase by 5 million. And let's say disposal proceed. Parent has received 8 million. Now, what is the double entry? Cash 8. NCI is increased by 5. Then basically total net asset of the subsidiary were 100 million, including goodwill. I will only add the goodwill if it is a full goodwill method. In case of partial goodwill, I'll restrict to only 80 million. NCI is increased by 5. Now try to understand. The rise in the NCI is 5 and I'm being a parent getting cash 8. So there's a gain. So OCI will be credited to 3. And obviously the entire 3 goes to parent. Is this clear to everyone? The main difference, look at this. When parent was selling 5% holding, I did not check what is the value of NCI at the date when parent is selling 5% holding. I did not check. When parent sells some of the holding to the NCI and control is retained by the parent, on that day we check what is the fair value of net asset disposed of, what is the fair value of the net asset of subsidiary at disposal. Multiply the holding which parent is selling. If it is a full goodwill method, again I'm repeating, if it is a full goodwill method, multiply by the percentage. If it is a full goodwill method and we do have a goodwill at disposal, then multiply by the holding which parent is selling to the NCI. This is a very different calculation than this one. Look at this. When parent was buying 25% holding from the NCI, what we did? First, we calculated what is the NCI value of 20%. Then we took that 55.20. So you can see that both the calculations are very different. When do I need to calculate the value of NCI first? When I'm buying some of the holding from NCI. But when parent is selling some of the holding to NCI, then it is always the net asset of subsidiary. I hope it is clear to everyone. You can see that the increase in the NCI will be the share of net asset. Share of net asset always, and goodwill. But when the issue of goodwill comes, fair value method only of the subsidiary at the date of disposal, which parent has effectively lost to the NCI. I hope it is clear to everyone. Yes or no, please quickly reply. Let me save this handout and this will be also uploaded on the portal. Don't worry at all. Okay, IAS, let's quickly discuss IAS 21, functional currency. Okay. Functional currency, we know that the meaning of the functional currency is the currency of primary economic environment in which entity operates. IAS 21, effects of changes in foreign exchange rates, state that functional currency is the currency of the primary economic environment where an entity operates. Factors used to determine a functional currency are as follows, and you will be, I would say, surprised to know that these factors, they have been asked many times in SBR, that how do we decide the functional currency? What is the importance of deciding the functional currency? The importance of deciding the functional currency is, other than functional, every currency is the foreign currency. And exchange gain and losses, they will arise when we are dealing with the foreign currency. Let me repeat why it is so important to decide the functional currency, because IAS 21 says, other than functional currency, foreign currency means which is other than functional. So what are the factors? Number one is sale prices. Let's say we need to decide the functional currency of XYZ company. You just check the sale prices. If majority of the sales is in dollars, assuming 70% of the sale is in dollars, 30% of the sale is in pound sterling. So I'll be more towards dollar considering as functional currency. Another is, let's say, competitive forces. Now, what do you mean by competitive forces? Just an example, okay? Simply, if I talk about the competition is happening in which currency? In which currency your competitor they are charging? Competitive forces does not only mean the competition which is coming from your competitor. Actually, competitive forces, competition does not only come from your competitor, from your rival company. There are other factors as well. Your competition can even come from the buyer. Just imagine if your company depends on a particular buyer, let's say 70% of sale belongs to one buyer. So can I say that you are facing a competition from that buyer as well? Why? Because if that buyer says, I will be paying you less money, if that buyer says, reduce the prices, I think you are going to reduce it. Why? Because the 70% of the revenue is coming just from the one buyer, one customer. So competitive forces, I would say, does not only mean the your competitor. It can be a buyer, okay? Competitive forces can be even your substitute products. There are a number of there's a huge discussion on that. But the main thing is you just check if there are, let's say, substitute products are there, they are available in which currency. If the competition is determined, so it is determined in which currency. If I talk about Pakistan, so normally the competition will be in PKR. Almost every company is selling their goods in PKR. Okay. Purchases and cost. Let's see the majority of the, let's say, majority of the payment to the supplier is made in which currency? Majority of the payment to the supplier is made in which currency? That is also one of the factor of deciding the functional currency. Receipts. Let's say your business generates receipt from their operating activities in which currency? A majority of the receipts which you are generating from your operating activities in which currency? That is also the factor of deciding functional currency. The last one is financing. If your company needs financing and you want to raise the finance, normally in which currency you raise the finance? So let me repeat. If we need to decide the functional currency in a particular question, then you just check the majority of the sale of that company. You just check the competition is determined in which currency. You also check the majority of the payment to the supplier. You also check the majority of the payment to the employees is made in which currency. You also check in the question that the cash which they are generating from their operating activities, receipts, let's say they're keeping in which currency. If they need finance, so normally they raise the finance in which currency. That these are the factors, they will help you to decide which currency is the functional currency. Why IES 21 has given us so many factors to decide the functional currency? There's only one logic behind that. That is, other than functional currency, every currency is your foreign currency. And let me tell you one thing, functional currency has to be only one. Functional currency has to be only one. It cannot be more than one. If you ask me, there's one concept, the name of the concept is presentation currency. Presentation currency can be more than one. Actually, presentation currency is decided on the basis of in how many stock exchanges you are listed. There's a possibility your company is listed at Pakistan Stock Exchange and your company is also listed in, let's say, London Stock Exchange. Then you have two presentation currencies. In Pakistan, you are preparing books in PKR, and in UK, you're preparing books in pound sterling and you send them to the UK stock exchange. So presentation currency can be more than one, but functional currency has to be only one. Now, this is very important, very, very important. A subsidiary that operates with little autonomy means independence will most likely to have the same functional currency as its parent. Very important. A subsidiary, actually, I don't know you have noticed this or not. Most of the time, what happens when there's a question on overseas subsidiaries, so examiner normally writes one sentence, and that is that overseas subsidiary is operating with the autonomy, means overseas subsidiary is an independent subsidiary. The concept says, IS 21 says that if a subsidiary operates with a little autonomy, means little independence is there, then it is most likely that your subsidiary will have the same functional currency which is parent. For example, let's say parent is in, assuming USA, subsidiary is in UK, but whenever subsidiary needs financing, whenever they ask parent to give them the financing, they get the money in dollars. Number two, let's say whenever, assuming if they want to decide the selling price, parent is the one which facilitates them how to decide the selling price. If they go for investing activities, parent is the one which basically help them in every area. For example, whenever there's a decision on investing activities, it is made by the parent. No input is taken from the subsidiary, let's say. In case of what should be the selling price, parent is the one which decides everything. Plus, whenever finance is needed, it is always taken from the parent. If whatever issues they are coming in the subsidiary, each and every time the help is coming from the parent. If this is the case, we'll say that where is the independence of the subsidiary? So if the question says your subsidiary is not operating independently, then the functional currency of parent and the subsidiary will be same. Okay. Overseas transaction, initial transaction, translate into functional currency using spot, historic rate. Simply spot rate means exchange rate on transaction date. Okay. Settlement, translate the settlement into functional currency using the spot or historic rate. Again, on settlement date, whatever is the exchange rate, use that. Difference is going to be either gain or loss, and gain and loss goes to income statement. If unsettled, there's a possibility. The treatment depends on whether the overseas item is a monetary. Monetary means, I'm talking about, let's say, accounts payable, accounts receivable. Monetary means where fixed cash is decided. Like in case of accounts receivable, we know that how much we are going to get. Accounts payable, bank loan, we know that how much we have to pay. If unsettled transaction is a monetary item, if monetary, receivable and payable loans, retranslate at closing rate. And whatever exchange gain or loss comes, that goes to P&L. If non-monetary, like property, plant and equipment, inventories, do not retranslate. However, if held under a fair value model, the fair value need to be translated when determined. This is very important. Please listen carefully. If transaction is unsettled, you just need to know one thing. If it is a monetary item, by using closing rate, we have to retranslate them. Closing rate means exchange rate on SOFP date. Closing rate means exchange rate on SOFP date. And whatever exchange gain or loss comes, that goes to P&L. If it is a non-monetary item, could be property, plant and equipment, inventories, investment property, do not retranslate them. However, if held under a fair value model, it means that if you're keeping property, plant and equipment, let's say inventories, your investment properties at cost model, then no retranslation. Let's say property, plant and equipment, you are following revaluation model, investment property, you are following fair value model. If you are keeping them at fair value, then if held at fair value, the fair value will be need to be translated when determined. So obviously, if you are keeping them at fair value, then whenever fair value adjustment is carried out, you have to retranslate. But a very important concept is, in case of non-monetary assets, which you have kept at fair value, you will retranslate them whenever fair value adjustment is carried out, and exchange gain and loss, they will go to the same place where normal fair value change is going. In case of IAS 16 revaluation model, revaluation goes to OCI. So the exchange gain or loss will also go to, automatically it will go to OCI. There's no need to show it separately. In case of IAS 40 investment property fair value model, fair value changes, they go to P&L. So automatically exchange gain or loss will go to P&L. There's no need to show separately. You just need to know one thing. Let me repeat. In case of non-monetary items carried at fair value, you have to retranslate when fair value adjustment is carried out. No need to show separately any exchange gain or loss. Now let me share another. If subsidiary company keeps on depreciating, how? If subsidiaries currency keeps on depreciating, I think we'll see the consolidation. Don't worry at all. Okay, there's a question. The question, please look, you are asking in parents' individual books, am I right? There's a question: if subsidiary currency keeps on depreciating, how to show the value of subsidiary in parents' book, individual books? Okay, student, we have discussed. Can I say in parents' individual books, how many options are available? Can you answer? How many options are available to keep the investment in individual books? How many options are available to keep the investment in individual books? I'll be following IES 27. How many options are available to keep the subsidiary in individual books? Can I say one, keep them at cost? 3, yes. One is to keep them at cost. Second, IFRS 9. Third, equity method. Got it? So now the currency is depreciating, appreciating, no issue at all. There are 3 options. You can choose any one of them. In individual books, parent can keep the investment at cost under IFRS, or second is or IFRS 9, and the third is like investment and associate. I hope it is clear now what to do in individual books. Okay, let me save this page and share the next one. Yes, inshallah, consolidation revision will be completed today. Don't worry at all. You can see that we are on the last topic of consolidation, that is group statement of cash flow, and after that we'll go for the past paper questions. Don't worry at all. Group statement of cash flows, group statement of cash flows. A statement of cash flows enable users of the financial statement to assess liquidity, solvency, and financial adaptability of a business. So cash flow statements, they give you the information. Obviously, from the operating activities, you will get to know how liquid is the organization and what are they doing in their investing activities, what are they doing in their financing activities. Cash flow is the only statement which gives us such information. Another thing is, after the revision of course, consolidation and the past papers of the consolidation, in the coming week, we'll be doing the remaining areas like current issues. We'll be revising the current issues, S1, S2 sustainability standards as well. So the coming week is going to be a last live revision class, and we'll be completing each and everything. Don't worry at all. But obviously, I have to cover all the questions which I have shared in your WhatsApp group. So don't worry at all. Even I would say, even if any student has taken live revision classes properly, I would say that can help you a lot to cross that 50 mark benchmark. Just not only the live classes, but of that live classes, it is going to save your time. In a very short period of time, you can revise almost the entire SBR. Okay, definition. Cash consists of cash in hand and deposits repayable upon demand less what? OD. This includes cash held in a foreign currency. Good. Cash consists of cash in hand, deposit which are repayable on demand. We are talking about, let's say, OD. Now listen carefully. When we are calculating cash and cash equivalent, student, very important point is coming when we are calculating cash and cash equivalent. From the cash, I will deduct OD. From the cash, that's great. Thank you very much. Thank you for appreciating live revision classes. I hope that with a very generous heart, I've given the time to your live revision classes. I did not compromise on these live revision classes. You have seen that. If you just go back and recall a very first live revision class where I just hardly took for maybe 40 minutes, 45 minutes. But in that class, I used to mention that slowly and gradually we will increase the time. And I think today you people are witnessing, yes, it is happening. And we are doing this in every paper, means every paper. And you have no idea at all. I have curtailed, I would say, 80% of my activities, which I was doing. Now I'm giving almost 100% of my time to my college and to my students. So now full dedication to my students. Okay. Cash consists of cash in hand and deposit repayable less OD. Now, it's very important, student. When we are calculating cash and cash equivalent, OD will be deducted. But let me tell you one thing. If I need to write in exam, so I will write like this. For calculating cash and cash equivalent, OD will be deducted. But I can change the wordings. Then after that, I'll say if OD is used as permanent source of finance. OD is used as permanent source of finance. Then instead of taking OD in cash and cash equivalent, I will take OD in a financing activities. Now, how do we know that, sir? It is used as a permanent source of finance? For example, your OD facility is 5 million and all the time the 5 million is used. All the time. It looks that you are using OD as a permanent source of finance. So simply when you are just, there's no calculation, there's a discussion. When you are discussion, why you are restricting yourself to one line? Why you are restricting yourself to one concept? When the same item can be discussed in two ways, you should be discussing it. If a student is just writing that OD while calculating cash and cash equivalent, OD is deducted, perfectly fine. But there's one more student who says it will be deducted while calculating cash and cash equivalent. But if company is using OD as a permanent source of finance, then it will be taken in a financing activities. It will no more be a part of cash and cash equivalent. Cash equivalents are short-term, highly liquid investment that are readily convertible to non-amount of cash and are subject to an insignificant risk of changes in value. Normally, if examiner says you have a short-term investment, maturity period is less than 3 months or within 3 months, they will be matured. Then those short-term investment, which will be matured within 3 months, we take them in cash and cash equivalent. We assume that within 3 months, the value of investment will not fluctuate significantly. Here comes the format of group statement of cash flow. We have profit before tax, cash flows from operating activities, 2 columns. Adjustment for, look at this. This format can help you also while solving the question. Adjustment for. Depreciation we add back, it's a non-cash item. Impairment loss add back. Most of the time, the impairment will be in in the goodwill. And let me tell you, you have to check what is the amount of impairment in the goodwill. When do I need to check the amount of goodwill in the impairment? Let me give you the idea. You are solving a question, okay, and during there is an acquisition of subsidiary. It means the goodwill has come. An examiner has given you the value of BD and CD of goodwill. So just do one thing. The T account of goodwill can help you to check impairment loss. Goodwill, we have brought down. Let's say we have carried down. Additional goodwill. Now, what do you mean by additional goodwill? What do you mean by this? The new subsidiary which you have acquired during there, okay? What do you mean by this additional goodwill, student? This is not something. Additional goodwill means acquisition of a subsidiary during there. I'm repeating it. Please don't take it any other way around. Additional goodwill means acquisition of a subsidiary during there. Let's say if this is the case. A very simple T account. Obviously, if there is a disposal of a subsidiary during there, it will come on a credit side. Let's say it is 90. This is 70, so it has to be 90. So balancing figure is your impairment loss. If examiner has not given you the impairment loss and the data is that during there we are acquiring a subsidiary, examiner has given you the BD, CD, go and check for the impairment because impairment comes in operating activity. Profit and loss on the disposal of non-current asset. If there is a profit, that will be deducted. Why we are deducting a profit? Basically, we are dealing with cash flow statement. I'm more interested to know what is the disposal proceed of non-current asset rather than gain or loss on disposal. We are doing cash flow statement, cash flow. So tell me how much cash we have got rather than telling me what is the gain or loss on disposal. That is why what are we doing? We are just deducting the profit element from the, we are deducting this profit on disposal. If there was a loss, we would have added. Share of associate of profit, I'll deduct this. Because logically the share of profit from associate, that is a non-current item. I want to know, have I received any dividend from my associate? I want to know during there if I have purchased an associate by paying cash. I want to know that. If you're just telling me the share of associate profit, that is non-cash for me. That's why I'm deducting it. Where is my interest? My interest is I want to know how much dividend I have received from my associate. That will be in an investing activity. If I have purchased during there any associate by paying cash, that will be a cash outflow in investing activities. I want to see that. Investment income like interest income, I don't want to see how much interest income is coming in the P&L. I really want to know exactly how much interest I have received. I'm adding the finance cost. Again, there could be a difference between the finance cost which is coming into the P&L and the finance cost which we have actually paid. The best example is, I would say, IFRS 9. We take finance cost on the basis of effective interest, but actual interest payment is on the basis of, let's say, coupon rate, cash interest. So simply whatever interest you have deducted from the P&L add, we need to actually deduct interest paid. After that, if there is increase in inventories, we are deducting. Now the question is, why increase in inventories we are deducting? Please try to understand one thing. Can I say when your closing stock increases, your profit will increase? Yes or no? Please reply. Actually, when closing stock increases, profit will increase. Can I say my closing stock has increased? Okay. And due to increase in the closing stock, profit has increased, but actually it is not in the form of cash. Have you got any cash? No. Deducted. So increase in inventory we are deducting. Increase in receivable will be deducted. Actually, increase in receivable means try to understand increase in the credit sales. Can I say there's an increase in credit sale which has actually increased the profit, but it has not actually increased my cash. Right now, I want to see cash in, cash out. So increase in receivable will be deducted. What is the logic behind increase in receivable? Let me repeat. Increase in receivable means, let's say your credit sale has increased. Due to increase in the credit sale, the profitability has increased, but not my liquidity, not my cash position. That is why I'm deducting the increase in receivables. Increase in payable, we are adding it. That's something very good. Try to understand. Last year, 2024, now it is 2025. Your trade payable is 200. Previously, it was 120. So during that, there's a rise of 80 million in the trade payable. Now try to understand. When I'm buying goods on credit, okay, obviously purchases debit, accounts payable credit. Purchases debit, when I'm going to debit the purchases, my profitability will reduce. But can I say, even though the profitability has reduced, but logically, there's no cash outflow. Are you getting this point? I did not make any payment. Purchases debit, payable credit. Debiting purchases means you have reduced the profitability. But can I say there's no cash outflow? That is what I'm doing. I'm adding the increase in payable. Are you getting this point? In fact, it is sort of, you can say it is sort of a financing, which is coming from the supplier. But we have to show that in operating activities. Okay, we have in the format we have shown everything in the increase. If decrease comes, so opposite. Okay. Then cash generated from operations, interest paid will be deducted, income tax paid will be deducted. If there is IAS 19 employment benefit is there in the question, and then we also deduct contribution paid. Always remember one point. Benefit paid is not my cash outflow. Can I say benefit paid means I've taken the fund from the trust and we have paid. That payment is coming from the trust. Benefit paid is not my company's cash outflow. Contribution paid is my company's cash outflow. Now there are few things which you need to understand properly. Consolidated SOF. 2000, let's say 25, 24. Inventories. 1000 and let's say 700. 1007 and group SOFP. Okay, don't forget this. All the rules are same for inventories, receivable and payables. So we'll be discussing on one. Case A. During 2025, parent acquired 80% holding in subsidiary. Let's say S2, could be S1, whatever it is. The main concept is during the parent got the control in a subsidiary. And during 2025, okay, please don't forget this. An examiner says that subsidiary was having inventory, let's say, 100. Please don't forget the scenario. During their parent has got the control, parent had acquired the subsidiary. Okay. And let's say cash paid by parent is 600 million and subsidiary was having cash 50 million. Please try to understand. During 2024, parent got 80% holding in subsidiary S2, S1, whatever it is. And subsidiary was having inventory 100 million. Cash paid by parent is 100. And when we acquired a subsidiary, so subsidiary was having cash 50. Fine. Number one, listen carefully, Hugo. Acquisition of subsidiary. Acquisition of subsidiary is an investing activity. Repeat. Acquisition of a subsidiary is an investing activity. It's not an operating activity. That is why there should be zero effect of acquisition of other subsidiary in operating activities. Why? Let me repeat the reason. Acquisition of a subsidiary is an investing activity. Now, what are we going to do in the operating activities while calculating changes in the working capital? You have acquired the subsidiary during the, look at this. Acquisition of subsidiary. Please keep watching. First, you have to deduct the stock from the closing stock. Because when I have acquired a subsidiary, then the impact of the inventory will be in the closing stock. Can I say this 100 million impact cannot come here? Yes or no? In 2024, there wasn't this subsidiary. So 100 impact cannot be into this 700. Are you getting this point? Students, please reply. The 100 million impact is with, that's great. Acquisition of subsidiary. So 100 million will be deducted from the, let's say, closing stock. I've deducted that 100. I'm left with 900. So look at this. The difference of 700 and 200 I'll take, which is 200. This 200 will be the increase in inventories. This 200 will be the increase in inventories. The same logic applies when you are checking the change in the receivable. If during their parent has acquired the subsidiary, first deduct the receivable amount from the closing receivable, then take the difference. Same applies on trade payable as well. First deduct subsidiary's trade payable from the closing trade payable and then take the difference. Now, let's come on investing activities. Then I'll show you the case B. Investing activities, as we have already discussed, acquisition of subsidiary. Acquisition of subsidiary. Acquisition of subsidiary is an investing activity. Now, student, listen. Only we will see how much cash is involved while acquiring the subsidiary. Look at this. Cash paid by parent is 600. But when parent acquired the subsidiary, at that time, subsidiary was having a cash 50. It means that if you ask me, I'll say cash purchase of subsidiary. I'll take 600 minus 50. It will be 550. Check this. Only 600 will not be your cash outflow. Are you getting this? If you are paying 600, how can you forget you're getting 50 as well? Is this clear? Yes or no? Students, please reply. Now, let's come here. Consolidated SOFP 25, 24 inventories. Let's say 1,800. During 2025, parent sold the subsidiary. Not acquired, sold. And let's say that subsidiary which parent has sold at that time, subsidiary was having inventory of 200. Disposal proceed, parent has received, let's say 700 million. And at the time of disposal, the subsidiary was having cash 300. Again, listen carefully. Disposal of subsidiary is an investing activity. It's not an operating activity. Since you have sold the subsidiary, look at this, what I'm doing. Let me change the color. Okay. Disposal of subsidiary. Can I say the impact of 200 will be in the opening stock? First deduct from the opening stock. Now can I say there's an increase in the inventories by 400. So when you are selling, obviously during there, either it will be acquisition of the subsidiary or disposal. If there's a disposal of a subsidiary, what do you need to do? First, deduct the balances from the opening values and then take the difference. Same applies for the receivable and payables. Is this clear to everyone, student? What to do in case of disposal of the subsidiary? Now, come here. Investing activities. We'll see how much net disposal proceed or net receipt we are getting by selling the subsidiary. Disposal proceed. Parent has received 700. But can I say when parent sold the subsidiary, at that time the subsidiary was having how much cash? So logically the net receipt is, I hope it is clear to everyone. And we have already discussed one past paper, if you people just recall, these small concepts, they were examined once. Remember? The acquisition of the subsidiary was dealt incorrect way. So I hope now it is very much clear what to do when we are buying the subsidiary during there, what to do when we are selling the subsidiary during there. Okay. Another thing, taxation T-account, brought down current tax plus deferred tax. Carried down current tax plus deferred tax. Keep watching, okay? Let's say I'm taking SOCI, tax in the income statement. Tax in the income statement. Now, please listen to me carefully. We have done IAS 12. There is one scenario in IAS 12, that is, can I say, if deferred tax is arising from the revaluation surplus, if deferred tax is arising from the revaluation surplus, it will be charged to revaluation. It will be charged to OCI. So if you have any deferred tax in the OCI, take that also, OCI. Deferred tax in OCI. Okay. Please listen carefully. If during the year, if during the year you have acquired the subsidiary, if during the year you have acquired the subsidiary, an examiner has given you the information of taxation, then acquisition of subsidiary will increase your tax. It could be current tax, deferred tax. Over here, let me give you one example. Let's say during the year you have acquired a subsidiary. There is a fair value adjustment. If the deferred tax is arising due to that fair value adjustment, so you have to take it here. If the deferred tax is coming due to that fair value adjustment, it will come here. We know that when the deferred tax arises due to fair value adjustment, impact of that goes to actually goodwill. But if you ask me the taxation T account, obviously the taxation value will increase. Okay, now, if during there you have sold a subsidiary, disposal of subsidiary will reduce your taxation liabilities. The balancing figure here, that will be income tax paid. The balancing figure here will be income tax paid. Okay. One more T account. Investment and associate, we did discuss also. Investment and associate. If you have BD, take that. CD. Okay. Share in associates PAT. If there is OCI, I'll take share in associate OCI. Let's say dividend received. Now there's a possibility you do not have any BD, assuming, but you do have a CD, which shows that during the year you have purchased the investment and associate. An examiner says you bought the investment in associate for cash. Balancing figure will be cash purchases. Obviously, either the balancing figure will be cash purchases or dividend received, depends on the data. Because from the same T account, sometime we'll be calculating dividend received, sometime we'll be calculating cash purchases from the same T account. Depends on the data. It will automatically lead you to calculate. Obviously, one unknown value I can calculate from this T account. Come here. Property, plant and equipment. Non-current assets. Brought down value I'll take from the group SOFP. Carried down value I'll take from the group SOFP. Okay. Depreciation expense. Okay. My voice is distorting. It is still happening, please. I think it was just for a few seconds. Quickly, please clear this. I hope the voice is clear now. Can you reply, please? Or should I pause the recording? Let me. Okay, it's better now. Property, plant and equipment brought down, carried down, depreciation expense. If there is any impairment loss, I'll take that as well. If there's any impairment loss, I'll take that as well. Now, please try to understand what I'm saying. If during there you have acquired a subsidiary, can I say in case of acquisition of subsidiary, I'm just interested in one thing. How much cash you have paid while acquiring the subsidiary? It means that what I want to say, look at this, what I'm doing. I'm writing here acquisition of subsidiary, but obviously acquisition of subsidiary means I'll take only the property, plant and equipment part here, not everything. Got it? I will take that property, plant and equipment part here. If examiner says at acquisition of subsidiary, assuming there's a carrying amount of 100 and fair value adjustment is 20, so I'll take 100 as well as 20. Yes, in the spreadsheet, you will be preparing these T accounts to calculate the unknown value. Okay, if there is a disposal of subsidiary, so obviously when the subsidiary goes, disposal of subsidiary, so the non-current asset, they will go also. Balancing figure here. Okay, if during there any revaluation surplus is there during there, I'll take that revaluation, which has, if there's a revaluation surplus during there. But examiner will give you this information, okay? Balancing figure will be the cash purchases. Balancing figure will be the cash purchases of your property, plant and equipment. Now come here. Cash flows from investing activities. Dividend received from associate. Interest received. If there's a purchase of property, plant and equipment, outflow. Sale proceed from the property, plant and equipment. Acquisition of subsidiary, only the cash one, okay? Net cash acquired. You will have net cash used in investing activities. Now let's talk about the financing activities. Issue of ordinary shares, repayment of loan, dividend paid to NCI, dividend paid to the parent share. If parent has paid the dividend, I'll take that also. Dividend paid to NCI. Now dividend paid to NCI, come here. This is also important. Non-controlling interest, NCI. Brought down. Carried down. Now please listen to me carefully. If during the parent has acquired a new subsidiary, that will increase NCI until unless parent is having 100% holding, then NCI will not come. What I'm doing, look at this. NCI at acquisition. But I said, if during the year parent has acquired a new subsidiary, take NCI at acquisition. Okay. Now what else? NCI share in PAT. NCI share in OCI if we have. So can I say NCI at acquisition obviously will increase the value of NCI. NCI share in PAT will increase the value of NCI. NCI share in OCI will increase the value of NCI. Okay. Now, if during there we have sold the subsidiary, can I say then NCI disposal? Balancing figure will be dividend paid to NCI. So if during there we have acquired a subsidiary, so NCI acquisition, and due to share of NCI and PAT, NCI value will increase. Share of NCI and OCI of subsidiary will increase the NCI value. If there is a disposal of subsidiary, then obviously NCI will reduce. So NCI disposal will be debited. So the balancing figure is dividend paid to NCI. Now come here. Cash generated from operations. IAS 7 allows cash generated from operation to be presented in one or two ways. Indirect method. So you will see indirect method in your past papers. Don't worry at all. This starts with the profit before tax, adjusted it to remove the effect of non-cash transactions, as we have seen, and transaction related to investing, financing as per performance. Direct method. This shows operating cash flows, receipts and payments such as cash receipt from customer, cash payment to supplier, and cash payment to employees. But in exam, you will see indirect method. Don't worry at all. Even though IAS 7 encourages the direct method, but please follow your exam, what your exam says. Dividend paid to non-controlling NCI. NCI brought forward. Look at this. NCI at acquisition the value of NCI will increase. Add NCI share of profit and OCI. Less NCI disposal. Look at this. If you are, instead of calculating the dividend paid to NCI through a T account, if you are good at this statement format, you can follow this in working also. Are you getting this point? This format is 100% acceptable. Brought forward NCI, what are we adding? So it means, student, come here, please. Can you see these all T accounts? In exam, you can make like this in a statement form. Are you getting this point, student? Yes or no? Both the formats are acceptable. Make sure you should be good at. You should be really good in at least in one way. Either it's a T account or a statement format. Is this clear to everyone? Yes or no? Okay, now let me share the questions. Let me pause the video. Let me discuss this one more. I think handout on SBR consolidation. Wait. Okay, student. Let me just tell you what are exactly we left with. Because today's class is already very long. I don't want to keep it again. I don't want to prolong it. Now listen carefully. In consolidation, please note we are left with group accounting for a foreign currency. We did not discuss if there is an overseas subsidiary. This is the only area which is left in consolidation revision. After that, past paper questions I have shared with you. I think there are 4 past paper questions from the recent attempt which we have to discuss. 2 things. That in addition to that, we'll be discussing. I hope you people can see this screen where it says changes and development in the financial reporting. Yes or no, please? Can you be quick to reply? Okay, I'm just telling you what are we left with. One is group accounting of foreign subsidiary. First, we'll revise that. After that, one question is still left for the revision from the previous class, I would say. 4 consolidation questions. Then changes and development in the financial reporting, that is cryptocurrency we'll be discussing, initial coin offering, natural disasters. This area we have to discuss. And I'm just telling you what still the revision area which is left. We'll be doing a quick revision of IFRS 13 as well. Please, you should be noting also so that I should not skip anything. Okay, just a minute. Let me show you something more important. Ethics, we have seen. Analysis and interpretation, we'll do also the revision of normal ratio analysis and alternative performance measures. Changes in the development and financial reporting, that is, it says page 70 to 72, that is, changes are very important. Changes and in interpretation of in analysis and interpretation, if I just show you, just a minute. Yes, here. Very important area, I would say. In analysis and interpretation, we'll be discussing these ratio analysis, traditional and alternative performance measures, non-financial information, sustainability. Students, again, extremely important, extremely. S1, S2, extremely important. We need to discuss this. We will also be discussing S1, S2. We will be revising. In fact, all these S1, S2 in a really good amount of detail is already included in your pre-record lectures, okay? But these revision, they're important. S1, S2 advantages, disadvantages, European sustainability reporting standards. We'll see integrating reporting. We'll go through, don't worry at all. Management commentary we'll have to see. So student, these are the remaining areas in the revision, okay? I've just mentioned, and I'll do one more thing. I'll be putting the note. I'll ask the admin to share what are the remaining areas which we are left with in SBR in your relevant WhatsApp groups. But for that, obviously, student, now I have to take classes because we have to complete till coming week. Is going to be, I think, maybe, I don't know, on Saturday, will it be 15 or 16? So that revision classes should be completed. So please, I'll be conducting the revision classes now more or less every day, more or less. But the time period of the class will not be long because today's class was very long and it was very necessary also. I'll try my best to take small classes so that coming Saturday, the duration of the class will be around 4 hours, I would say, or 3 to 4 hours. But coming Saturday, inshallah, we'll complete the entire revision. And you people have and there will be, we have already discussed, if you people recall, a number of past papers, and all together in the revision, you will be having extremely important, I would say, I will share around 20 extremely important questions you will see in your live revision classes. And on coming Saturday, I will also announce the mock also. Please, I want everyone to attempt the mock, okay? Please don't skip the mock. I'm going to personally check your mock. I'll give you the feedback personally. And mock gives you the opportunity to check yourself, to evaluate yourself before the exam. Mock means exam before the exam. I hope the remaining agenda is clear to everyone, how we are going to cover the entire revision, because I don't want to prolong the revision classes. Coming Saturday, we should complete each and everything. Is this clear? Please reply, students. Where is everyone? Students, is this clear to everyone? So I'll appreciate if you people can take out, a little bit time every day, so that from Monday onwards, of course, not tomorrow. So it will be a really good, I would say, it will be really good for SBR and for you and for me, everyone, so that we can complete the entire SBR revision on time. So thank you very much, student. See you all, inshallah, in the coming live revision classes as well. Thank you.